The average Indian investor today faces unpredictability on multiple fronts. Israel and United States war on Iran, the United States yo-yoing on its trade policies, the AI-related technological disruptions, and the associated volatility of the Indian rupee. Now, this risks pushing Indian households back towards gold and real estate, just as the financialization of Indian savings was gaining momentum. How should policymakers respond to this threat? In my finance and governance column in ThePrint this week, I argue that policymakers should encourage Indian households and the custodians of Indian savings, such as pension funds and provident funds, to internationally diversify their portfolio. Even though gains from international diversification have been shrinking over the years, the war on Iran shows that an Indian portfolio, portfolio that is just focused on Indian securities, has fared much worse than an internationally diversified portfolio. Therefore, Indian policymakers should shed their decades old anti diversification stance and remove the frictions associated with international diversification for Indian investors. The logic of global diversification is simple. Assets distributed across different regions and countries tend not to move together. That is, they are less correlated than assets that are concentrated in the same region or country. Therefore, a portfolio that has assets distributed across different regions and countries acts as an insurance against country level or regional shocks. That said, the gains from international diversification have been reducing with the increasing integration of financial markets. So, financial econometrics literature written since the 1990s show that the returns from international securities tend to be more correlated with the returns from domestic securities across developed countries. Now, the bottom line, therefore, is that the gains exist, but they are shrinking. Diversification benefits also tend to shrink during war times because generally markets react simultaneously to geopolitical shocks. Wartime announcements generally cause a dip in returns. Estimates vary from 1% to 10% in the short run across developed markets. However, the effect and the dip is actually quite heterogeneous across different countries. Developed markets tend to move together. Regions and countries that are tied with the center of the war tend to move together. Therefore, the takeaway is not that diversification does not help, but that a truly internationally diversified portfolio is one that has assets both from developed and developing countries. For example, researchers have shown that on the outbreak of Russia's war on Ukraine, returns across developed countries dropped significantly. However, returns across select African economies did not drop as much. It is tempting to discount the virtues of international diversification in the face of war because gains are shrinking across the board. However, as the current war on Iran shows, a portfolio that is just focused on Indian securities has in fact fared much worse than an internationally diversified portfolio. Why do I say this? I ran an analysis of the net daily returns on four indices, stock indices that are widely traded around the world. I ran this analysis for the 2-week period beginning 27th February, a day before the United States attack on Iran, and ending on 11th March. This analysis shows that while Nifty, which represents the most liquid companies in India, fell by about 5.21%, S&P 500, which represents the largest countries in the United States, fell by only about 1.5%. Stocks 600, which represents the largest country scripts traded in the European Union, fell by about 4.95%, whereas the Chinese index was least affected. Now, this does not mean that that we should only invest in Chinese or the US stocks because such a portfolio would be vulnerable to shocks from those countries. However, what this does mean is that if you had a portfolio that was just Nifty or India focused, you would have made a loss of about 5.21%, whereas an internationally diversified portfolio with equal weightage across these four indices would have depleted returns by just about 2.95%. An internationally diversified portfolio, in other words, would have reduced your losses by 43%. The insight from diversification remains the same. Diversification would not have delivered real gains to the investor, but they would have reduced losses in a time of high volatility, such as the one that we are living in today. How do we square the diminishing gains from international diversification with the also diminishing losses from international diversification? For Indian policymakers, squaring this circle requires them to ensure that the returns from international diversification exceed the costs associated with them. Indian portfolios have so far been hobbled by decades old policymakers' stance against diversification. The Indian state either prohibits or imposes heavy transaction costs on allowing Indian investors to diversify globally. Three main policy interventions stand out. The first one is associated with the RBI's maze of controls on allowing Indian investors to invest offshore. RBI imposes a maze of controls on who can invest, what can they invest in, for what purpose, for how long, on what kind of instruments, and so on. Listed Indian companies, for example, are allowed to take exposure to listed stocks abroad up to a certain cap which is linked to their net worth. Unlisted Indian companies, on the other hand, are not allowed to directly invest in listed stocks abroad. One viable route that existed for allowing Indian households to diversify their portfolio was by investing in Indian mutual funds and ETFs that took exposure to global stocks. Now, there is a cap on the aggregate level of exposure that Indian mutual funds and ETFs can take to such stocks. That cap is $7 billion, and it has been exhausted since 2022. Therefore, the only viable route that was available for Indian investors to take exposure to global stocks and internationally diversify their portfolio has also stopped since then. The second intervention, the second route through which Indian investors can take exposure to global stocks is through the liberalized remittance scheme of the Reserve Bank of India. This scheme allows Indian investors to remit up to $250,000 abroad for every individual resident. By itself, this limit is sufficient to allow the average Indian retail investor to diversify his portfolio globally. However, there are severe transaction costs associated with this route. These costs come in different forms, such as minimum investment size, foreign brokerage fees, trading account related fees, and so on. There are also tax traps. For example, securities based in the United States attract a 40% estate tax for investment amounts exceeding, investment portfolio values exceeding a certain threshold. The recent TCS imposed on all remittances under the liberalized remittance scheme, this TCS is in the range of 20%, has significantly amplified the costs of investing through the liberalized remittance scheme. These transaction costs potentially make it absolutely unviable to to diversify one's portfolio, especially given that the gains from international diversification are shrinking. Finally, custodians of Indian savings, such as pension funds and provident funds, are prohibited by law from investing abroad. So, for example, the PFRDA Act, which governs pension funds in India, prohibits pension fund managers from taking exposure to international securities. The EPFO, or the Employee Provident Fund Organization, also has zero exposure to international securities. In sum, all our portfolios are focused, concentrated only on India, not by choice, but by policy design. The financialization of Indian household saving is one of the most important economic shifts of the past decade. But financialization without diversification creates fragile balance sheets. By restricting global investment, the Indian state is forcing us to concentrate all our investments in India. This is not a good thing. Indian policymakers should make all effort to reduce the transaction costs associated with offshore investments, allow us to diversify our investments, which is especially important in this era of massive global volatility. Thank you.